First rates, Monday morning, what are we starting with? Well, we're starting with an uptick of about 0.5% on the Nifty, and it is a good start. Solid market breadth, good start, decent opening for small and the mid-cap index as well. Now, when you have Reliance, ICICI Bank, HDFC Bank and HDFC Life, you don't have to capture too many small and mid-cap stocks. Let's look at them. 30 rupees higher for Reliance. 16 rupees higher for ICICI Bank. This is where I was hoping for a bigger move, which is HDFC Bank and HDFC Limited. But HDFC Life is where the real uncertainty, the veil of uncertainty is now lifted. 7% higher for HDFC Life. Remember, nobody likes it, nobody owns it. Underperformance has been quite stark and severe. And when you get positivity, that's how markets have reacted in the past. Now let's look at numbers which are due today, later this week. Bajaj Auto. Yeah, Microtech also Lodha, that's also reacting to news. I mean, it's just been such a comeback story for Lodha. From brink of going a debt default in the global paper to stock making a new high, and now they're talking about 14,500 crore of real estate sales. I mean, that's like $2 billion. Just bravo to what's happened to the entire real estate space, so to speak. If Lodha is doing well, other Bombay real estate companies will have to join on the bandwagon. Oberoi, Prestige, you got DLF. In the entire real estate space, I guess today is humming with positivity.
Oh yeah, absolutely. The entire realty pack holding us a buzz. Let's see what the Nifty Bank as well is up to, considering ICICI Bank's weight in the Nifty is almost 8%, but in the Bank Nifty, it's a good 23%. Nifty Bank higher by 0.6%. Let's revisit what ICICI Bank is up to. 899 is where that stock is, just about nudging actually that 900 price point. There's Axis as well, which is due to report its numbers this week. That is also holding out well, so look out for that. Wipro, after its buyback announcement, is up 1% as we speak right now. And a bunch of other stocks. There's Aurobindo Pharma, which has also got a US FDA nod for 2 of its drugs. Zydus Life, which has got a final US FDA nod for 1 of its ethyl capsules. There's MapMy India, which has come out with its numbers. The EBITDA has risen about 17.5%. Revenues higher by 27.25% on a year-on-year basis. MapMy India will just come off you on your screens next. And then, of course, on the negative side, there's Yes Bank as well, wherein the Q4 asset quality has declined on a sequential basis and the profits are below estimates. We're going to be chatting with the management as well just shortly on the show. 2.5% lower for Yes Bank as we speak. And then Sun Pharma, that's where you may be seeing a knee-jerk reaction come by given that the news flow is negative from US FDA for their Mohali facility, wherein there is bound to be disruption in terms of exports to the US. 3% lower nearly for Sun Pharma as we speak. But for index, Kunal, irrespective of RIL, ICICI Bank, the index refuses to budge.
Absolutely, Aisha. I think this is a very interesting sign for the markets that with such kind of news flow, such kind of events, the indices are still holding their grounds pretty well for themselves. So I think that's a very good sign for the index overall in terms of the structure and price trends. The trade which I would look to initiate at current levels would be on SPI. I think it's an interesting chart, as I mentioned earlier, that the stock is heading towards a breakout of above the 550 levels. Looks extremely attractive and could probably be the leader which the PSU banking stocks require from current levels.
Okay, so that's SBI as the first trade. Naresh, what is it that you're betting on, given that both you and Kunal were bullish on L&T and SBI?
So continuing to bet on IDFC, focusing more on the mid caps and small caps. The stock is given a breakout and holding around that price points only. So expecting a move here towards 90 in the short term.
Rahul Chadha joined us. Let's take a conversation forward. Rahul, fantastic to have you back. Thank you for joining us. Rahul, the bulls are back, but are they here to stay?
Nikunj, I think next 3-4 months would be challenging. And I think we saw that in IT services result, where there is a sharp demand slowdown which has happened in recent months. And I think it continues. US economy is slowing further, and likely that probably around fourth quarter of this year or first quarter of next year goes into a mild shallow recession. So I think that is where the slowdown is going to come in the Indian economy also. That's largely going to come from weakness in exports, and that impacts the job creation around it.
What should be the best investment strategy? There is a visible fear in IT, but there is a visible growth in banking. There is a visible slowdown in rural India, but there is a visible uptick in urban India. what is the best way to stay put in this market?
I think the best way to stay put is take a medium-term view. Look, near-term is going to be challenging, but that is where you get entry points. Most of us been saying that for a while, but look, in markets you don't make money every day, every month. You make money in spurts, and this is what we've got to understand. But if you're not positioned for it, you miss those spurts. And I think somewhere those moments are going to come either in the fourth quarter of this year or the first quarter of next year, when Fed worried about slowing growth and inflation becoming less of an issue, starts cutting rates. And that's where things would improve. And I think the rally here is going to be led by domestic cyclicals. We've seen strong set of numbers come over the weekend by the likes of ICICI Bank. Reliance has also done a good job. I think these are the names which would take the market to the next level.
Rahul, when we spoke to you last, you were about 30% of your exposure was in banks and financials. Now that investment has worked. But now are we reaching at that pivot point where financials will slow down, the base effect will kick in, deposit growth is slow, economy is slowing down. So one side, there is merit in recognizing that financials are core to everyone's portfolio, but are best of the gains behind us?
Definitely. Fourth quarter last year, which was 22, first quarter of 23, is going to be best for financials. NII growth is going to slow down from here. You would see these banks build up more contingencies also because some of the delinquencies are going to pick up. But look, life's relative. Such is going to be the slowdown in other sectors. But our view is, unlike the previous cycles where a lot of excess investment was done and it took a while to come out of that down cycle, we've not seen India or US done much of those excessive investments. It's largely in China where they've done the over investment, which is where growth is going to slow down. And I think that's where even if a down cycle comes, which is going to come in coming quarters, it's not going to be that harsh.
Rahul, are you surprised with the kind of IT reportage we've seen, the commentary from TCS as well as Infosys, or do you think that was well anticipated?
Yeah, but to be fair, our sense was still Feb. These guys sounded very bullish about the demand outlook. What happened was we had this mini banking crisis in US, the SVB crisis, and post that, some of these discretionary projects were put on hold, and that's why once these companies came and declared the results at the end of Q1, those were disappointing because one was not expecting such soft numbers so early in the cycle, basically.
Rahul, one pocket in India where you're not seeing any kind of slowdown is in the luxury market, be it high-end real estate, be it watches, jewelry, clothing, what have you. Cars as well, right? I mean, that of course is on a low base, but yes, cars as well as selling a lot more, especially when it comes to the, super segment. But tell me, what is that telling you about the underlying strength of the haves in India?
I think it's the same trend everywhere. You look at the performance of Louis Vuitton for last 6 months, it's one of the top performing names. It's done much better than the Chinese consumption names because look, it's super rich, who've done well. And this is something we've seen post COVID, basically the K-shaped recovery, as we say. The haves, as you call it, who have much resilient balance sheet, who've got much stronger incomes, who can weather the inflation better. And these guys have kept on with the consumption. In fact, post-COVID, they've come out and spent more. So that part of the market has been fairly resilient. Unfortunately, in India, we've got few plays. Probably you can say something like a Titan would be good plays on that. Something like hotels would be an indirect play on that. But there are not many plays on this space, basically, or this segment.
Hi, morning. I wanted to get in your take as well on the healthcare or the pharma sector. Do you believe that a re-rating is on the cards?
We've liked hospitals over generic pharma and continue to do so. Again, it's been hard to make money honestly in generic pharma. There have been few names here and there who have made money, but we continue to believe in this hospital story. What we see is a huge penetration story, which is there. We yet to see the benefits of medical tourism. We've seen that only for a quarter or two. That builds on that. So for us, hospitals would be a better way, lot more kind of a steady, predictable way to play this healthcare story.
I mean, these are businesses which are constantly hungry for capex. The return ratios are nowhere close to even 20%. So I can say that India needs healthcare, but that anybody would have said 20 years ago also, and that everybody will say 20 years after also.
So, Nikhil, what's happened is, and what's led to the re-rating of the sector is that government's not invested with pricing of most of the surgeries or services, etc. It happened about 5-6 years back, but these companies stopped the investment, and government realized post-COVID that you need these companies to do. I think the maths here is, if you look at the average revenue per beds, those are somewhere around 70,000-75,000. The ROCs are twice that of what you see in our hotel space, etc. And typically you buy these names when they've done bulk of the capex. Most of these hospitals are doing brownfield capex. None of them are doing large greenfield capex, and which is why what you said was relevant for a new hospital, but not for somebody who's adding 10% 10% beds to his existing capacity.
So as we look into the future, Rahul, let's say 2023 and beyond, how much weightage would you pay to the fact that there is a general election cycle same time next year? Do you think 6 months before that markets will be into a state of limbo, because historically we've seen a decision-making freeze 3, 4, 5 months ahead of the election?
So I think markets somewhere discounting that, which is why they move up, but they're not really touching those highs which we all thought they would this year, with the economy being in such strong shape. We've got state elections, and there are talks that some of the state elections may not go the ruling party's way. So I think there is going to be a skepticism on what happens in the general elections. So I think this is the period where market will start getting slightly worried about the outcome for May 24 elections. So I think those risks, those uncertainties would be somewhere baked in the valuations here.
Okay, that's the view coming in, but let's get in a sense as to what the outlook is as well when it comes to the entire energy basket. For instance, you have something like Reliance Industries that came out with their numbers, and we've seen the fluctuation as well in crude oil prices across the board. What's the outlook on energy as a space, given that it clearly is very news flow dominated?
Okay, so here we are talking of two things. One is crude oil prices. So clearly oil between 75 to 90 is good for India. And what one hears is, at the margin, though OPEC cut supplies, but there are additional supplies coming from Russia, which are not being adequately documented for which is where the world's kind of stocked with oil. The Chinese have stocked a lot of oil, so which is to India's advantage, that oil today is not at 125 but $85-90. And then when we look at stocks, look, clearly Reliance is promising, but what market fancies much more than the oils and the chemical story is the retail story, the telecom story. Things got a bit slow recently, but I think there's a longer term potential over there, and a very strong longer term potential. And in the coming years, as you see IPO of some of these companies, there's going to be even more excitement about the name.
Rahul, just an extension to the point that we were earlier talking about, the luxury theme. What's happening in the property market or the real estate segment as well is quite remarkable. We were just talking about as to how macro tech developers, or known as Lodha here, has upped its guidance significantly, beating all and every estimates. And the Q4 updates coming in from the other regional players as well is as strong.
Absolutely. I mean, we saw the sales DLF did in Gurgaon, and it was phenomenal what they did in terms of the property which was sold. And if I'm not mistaken, the average ticket size there was about 7 crores. So this is what happens when kind of the pent-up demand wakes up, basically. So for 8 years, nothing happened in the real estate market in India, whereas elsewhere in the world, there was a big real estate boom between, let's say, 2015 to 2022, etc. And now it's reversing. That post-COVID, people realize they need bigger homes, and property prices are moving up, which is what forcing people to act. So some of these names are promising. Post-COVID, we were a bit early in the names, and we built a sizable exposure in the real estate names. Though recently, or last 6-9 months, we pruned the position because RBI was hiking rates. But look, this is a good time to add these names from a 2-3 year perspective.
Do you see your top 3 positions changing in next 1 year, or you think you'll ride them?
I think highly likely. See, there's a bit of a defensive part of a portfolio, We've got consumer staples. We've got the likes of Power Grid in our portfolio. I think over 6-9 months, you will see higher weights for consumer discretionary. They're still part of our portfolio, but one would like to increase weights to them as one gets confidence that we've gone through this economic downturn and things improve significantly, or growth outlook would improve significantly in 24 and onwards.
Rahul, as per 31st January, though, your top 3 positions, your second one was actually Infosys. I don't know whether that still stands or not. Please correct me if I'm wrong.
Yeah. So I think because of the stock price, it won't be top 2, but probably still in top 5. We've not done much with the name. IT services would be still about 9 to 10% of our portfolio. Look, we believe in this long-term growth prospects. These are great companies, good free cash flow yields. And what we've seen is businesses globally realize post-COVID that digitization, hyper-personalization is imperative for staying relevant for the coming decades, and the spends are going to happen. Though what one is doing all the more now is figuring out what does these versions of your chat GPTs or the AIs, the developments which have happened means for the sector. It obviously leashes on a boom of productivity, but does it somewhere cannibalize on the revenues? That is to be seen in coming years.
All right, Rahul, appreciate your time and good to have you on ET now. We shift gears and look at markets. The 3 newsmakers today: Reliance, HDFC Bank, HDFC Life, and then to some degree you would say ICICI Bank. These are some of the important newsmakers. They've not propelled the Nifty as what we thought, but they're not damaging the market either. ICICI Bank is the one where the price action is the highest. 16 rupees higher for ICICI Bank. Numbers have been strong. Re-rating has already started. Dinshaw Irani joins us. Let's say good morning to him, understand where he's picking his spots in this market. Good morning, Dinshaw.
Morning, Nikunj. How are you?
All's well. My viewers say when Dinshaw is there, please ask the next multi-bagger idea. That's a reputation you have. It's a good reputation to have, by the way.
So Nikunj, I remember our chart pe charcha, which we did in September, and one of the questions you asked there was that are we contrarians? And our response was that we are probably early in our trade, and that's why we consider us contrarians. And I think in that same interview, you asked us about our view on IT, and we said we're negative. I think that's a classic example to give you that how we early in our trade and how it proves over the longer term. So having said that, the next multi-bagger ideas, we're still looking for them, right? So let's be very clear about this. But anyway, the fact is that our feel is that the market per se will look very exciting in the second half of the calendar. The first half, and we've been calling this out for a while now, that the first half will be in a tight band because we don't see the globe, the world markets pulling up much going forward. And that's why our belief is that India's inherent strength will ensure that the underperformance that it's been going through till date will further, we will rather improve and they'll reverse this trend. We'll probably be an outperforming market by the end of this year. And the bulk of the returns that you see, which we expect the markets to log a return of some 13, 14% over a calendar year, I think that bulk will come in the second half of this year.
Are you now tempted to look at IT? Because a year ago you sold IT and I asked you why. So I'm asking you now, why not?
Okay, so the call here is that, and frankly, I mean, we've been saying this for a while again, that June quarter is when the real poison will come out, right? Because you saw the March quarter numbers and everybody was very euphoric about March because, I mean, for some reason, the IT players didn't call it out in their December quarter numbers. And finally, the shock that they got at the end of March was not taken well by the markets, I suppose. But the fact is that they entered the June quarter on a downtrend. So you can expect that probably this quarter will be the worst off quarter. And even then, I mean, if you look at the valuations, I think still the street is quite high on the numbers, on the earnings bit. They haven't cut the numbers justifiably. We believe that that should come off a bit. And as a result, the valuation that you're seeing today, maybe they're at 10, 15% premium to the pre-COVID levels. But our feel is that once the numbers are cut, you'll see another 20% odd kind of valuation premium, which is going around the market, which is not justifiable, given the fact that you're not talking about mid-single digits kind of growth rates, which is akin to what the pre-COVID levels were. So your valuation has to come back in line. I think the excitement was because of COVID, and that got waned off. And I think now the valuation should come back in sync.
Dinsha, the one pocket where all the excitement is the luxury end, right? Everything from homes to cars to jewelry to watches. That's where people are spending. And you have been a keen observer of the consumer spends. Any other interesting new ideas?
Not really, Asha, because we've been actually searching for new ideas. And frankly, I mean, though we talked about the luxury trend that we picked up again quite early in the trade as such, and the point is that the demand per se is not looking that exciting, be it in the tier 1 towns or tier 2 towns or even the rural segment, because I think there's a pullback on demand to an extent, and we again saw this probably early, and that's why we trimmed a few positions. And now we're adding back to those names where we saw that the corrections have been overdone, and we've been adding back to those names as such. So otherwise, new names, we're not looking at, we're not being able to find any new names as such.
So it was Manyavar, it was Campus Shoes and Ethos.
No Ethos.
So Manyavar, Campus and fill in the blanks.
I won't. That I'll leave to
As a child, we played this game, fill in the blanks. Remember all the exams, fill in the blanks.
Yeah, I know. Some of them you showed just now, the retailer, the car distributor and stuff like that. So that one was there. So.
But Dinshaw, there is definitely an uptick in the urban stroke, the niche consumption pocket. But that is also a function of the real economy. That is also a function of what is happening to the aggregate picture. How disconnected do you think this space will be for an extended period of time from the real economy?
So, because actually, if you see, this kind of a dichotomy was happening for quite a while, even during COVID times, though everything picked up. But the fact was that the super luxury and luxury were totally in demand. And as I mentioned in one of your interviews, that the watches, you can't find luxury watches. They're out of stock. Patek Philippe or Rolex and stuff like that, they're really out of stock. So it's that kind of a super luxury wave which has come, and I think that's basically because of the way the income spreads are happening today. So, but the fact is that doesn't move economies, right? In India at least, it's like top 1% of the population can afford that, and the rest are not able to look at that. So that won't move your economy as such. What will really move is when the real mass consumption comes into play. And I think we're at the cusp of it. Actually, it's not probably in the immediate short term, you may see some pullback happening because of El Nino and things like that. But the fact is, or high inflation to add to that. But the fact is that we are on the cusp of that, given that our cohort of youth population is going to be the largest in the world very shortly. And that is what's going to pull up the economy as such. So we'll wait it out. Probably there's another couple of quarters of wait as such before things even out with the world also, and that's when you'll really see India moving up the charts.
So Dinshaw, which end of the market to your mind now deserves a further re-rating, both in terms of EPS and also in terms of P? Because luxury stocks or urban consumption or niche consumption, these are stories which are important, but these stocks are also expensive. The idea is to perhaps buy where you get both compounding in earnings and a big shot of P re-rating.
So basically, Nikhil, the fact is that our favorite sector, which is banking as such, you've seen the results, you saw the numbers. In fact, we ourselves were surprised by the numbers which came out, and you saw a bit of re-rating of the earnings as such. I think it's a matter of time before everybody realizes that NIMS is not the only story here. It's mainly the growth in credit which will pull up this sector to a greater extent. And I think it just started. With the March numbers, that is when you were seeing these mid-teens or 20s kind of growth rate and credit growth and stuff like that, which is going to pull up the earnings for the sector. And I think that's where the real re-rating comes in, because NIMS can pull it up to an extent, but actually the core business, when it starts moving up, when the re-rating actually happens, and that is what happened in the case of ICICI. You just mentioned before I joined that phenomenal numbers and the fact that the stock is up, but it's up in a very dull market. So you can imagine what it could have done in a bullish market. So our feel is that this is the sector where the real re-rating happen. And obviously, as things pick up, our consumption sector should also kick in a big way in terms of re-rating when the demand comes in back again on the cusp.
Okay, Dinsha, what about your outlook on the entire manufacturing theme and how you're really looking to play on this? Is there any expectation, for instance, when it comes to the numbers from some of these capital goods, defense or railway majors as to what you're expecting in the quarter?
So basically, Aman, the fact is that all these guys are so expensively valued today that if any disappointment comes in, which we expect to come in, because our feel is that I think the capexes on the government side are done and dusted, and the government doesn't have much money now to spend. It's mainly the private sector which has to kick in with the capexes, which will help in moving the ticker here. So our feel is that once that comes in, and frankly, I mean, that won't come in a rush, because as we said, that demand is slowing down, and obviously the capacity utilizations also will come off a bit, and that's when the private sector will not look at the capex cycle kicking in. It's only when the demand picks up and capexes capacity utilizations move up, that's when the real capex kicks in. So I think there's a wait out there, and our feel is that this space we're not too excited as of now, at least.
Dinsha, really appreciate your time. So glad you could join us. Meanwhile, markets hardly any push actually, hardly any push which is coming from because of ICICI Bank or because of Reliance. I mean, we're hoping for a slightly more bigger push, but the breadth I think is holding on. One stock which has done rather well for itself post IPO, very few success stories, is Kaynes Technologies. It's in the business of design and manufacturing, and in this entire market volatility, Kaynes, if you look at the 1 month chart, even 2 month chart from December, if you think about it, it's done rather well. Came all the way down to 700 thereabouts, and from 700, 940, it's done rather well for itself. That's the intraday graph. I'm going to just request the producer to perhaps look at the 3 month chart or the YTD chart just to establish how strong the outperformance in this particular stock has been. Ramesh Kannan, Managing Director of Kaynes Technology, joins us now. Ramesh, good morning. Thank you for joining us. Walk us through that, how things are looking up in terms of the quarterly performance. Q4 historically is always a good quarter for Kaynes. Has the quarter gone by been on similar past trends?
Good morning. See, this sector, I feel there is not order when compared to situation 6 months back. There are orders across different verticals. We see large orders coming in, and nowadays I frequently see there is enough potential in our business.
Ramesh, I think we've got you on a very bad audio line, so bit of a network issue there. We'll just dial you right back up. Tata Com, last week the management came on ET now, and they specifically spoke about the fact that there is no slowdown in the business, and we should stop comparing Tata Com with what other IT companies are doing in terms of other IT services. So you look at Tata Com this year, 52-week, 4 months into this year, the Tata Com stock has been a flat line. It's hugging on to that flat line, unlike IT services which have got completely bombed out. So Tata Com is holding on, unlike what is happening in the real world in IT services. But the stock today, which I think is just doing cartwheels, I think is HDFC Life. The overhang of the shareholding in HDFC Life, that concern gets lifted away. The news came on Friday, and the stock is reacting to news today, 6% higher for HDFC Life. I mean, this is one sector where we've not seen anything incremental in terms of any big changes also. So underperforming stock, when an underperforming sector, underperforming stock gets a boost of life, it definitely will see outperformance, and that's what you have. We also have an exclusive view from Mr. Deepak Parekh of HDFC Group on where India currently fits in terms of this global tumultuous environment.
So against this uncertain global backdrop, India has increasingly been in the spotlight for being amongst the fastest growing major economies. We are not immune to global disruptions, so some slowdown in growth is inevitable. But since India is a domestic consumption-based economy, the economy is less dependent with global economy. Unlike countries that rely on exports, we are not over-dependent on exports. We have such a large domestic market that whatever is produced is consumed here. I have been on record many, many times in the recent past that India has never been in a stronger position than it is today. In fact, I've said in my 50 years, I've never been as optimistic about the future of our country today as I am. As a country, we are fortunate to see more tailwinds and very few headwinds. What is working well for India is the fact that we have political stability. And I don't see this being disrupted in 2024 either. What is working in India's favor right now? We have food security. We have vaccine security. We have demonstrated the ability to negotiate the import of crude at a lower international prices, which has worked well for our foreign exchange purposes. There has been a steady increase in tax collections owing to better compliance by people. In fact, tax collections last year grew 18%, which was higher than even the budgeted estimates. And when I talk of tax, I'm talking of direct and the GST. Almost all high-frequency indicators are performing well, including a smart recovery by sectors that have been impacted by COVID, such as aviation and hospitality, amongst others. Probably aviation and hospitality are doing much, much better now than they ever did. We are reaping the benefits of having put in place a strong public digital infrastructure, which much of the world now wants to emulate. The Indian banking and financial system, which had its troubles in the earlier days, is now much, much stronger position. All banks are well capitalized, the non-performing loans have come down sharply, and the system is strongly regulated. We have a government that is pulling its weight to position the country as a global manufacturing hub. And we also have a government that has aligned itself to the goals of decarbonizing the Indian economy in an orderly manner. These are just a few of the many reasons why India is looking good and why India is looking attractive to the world.
Okay, that's Deepak Parekh talking about the India story and how it continues to be an attractive one for the long haul. But Ramesh Kannan from Keynes is back with us. Ramesh, apologies for that, audio glitch. Just, get back to your thoughts because you were talking about how the quarter gone by has been.
For us, it has been a good last quarter. And our sector, last quarter has been always good. Added to this, India domestic requirement has increased. Exports, yes, I am seeing a bit slowdown, but expecting by end of 2025, it to go up. So last quarter has been a good quarter for as far as Keynes Technology is concerned.
All right, moving right on then, I wanted to also get in a sense from you as to what the outlook is in terms of the recent order inflow, the kind of client conversions, what have they been like? Have you signed any new major customers of late? Are there any big orders in the pipeline? Because the order book as on December stands at about 2,558 odd crores, if I'm not mistaken.
Our order inflow has been increasingly growing, and I am seeing that we are getting orders from the second quarter onwards to fulfill at around 175 crores per month. If this being the situation, I feel the year should go very well. And then there are orders across different verticals. So even if one or two verticals go up, it is not going to fail as far as Kaynes Technology is concerned. We see in the railway sector, we see heavy growth in the connectivity, telecom, across all the industrial sectors, a high growth as far as Kaynes is concerned.
So for FY24, sir, what we should expect? I mean, analysts are penciling in a number between 130 to 150 crore. Are they realistic or are they optimistic? FY24.
It is very realistic because India domestic requirements are increasing, consumption is increasing, and government is putting on more focus onto the infrastructure. So our industrial PCBs are required for the capital items, and since these markets are growing, I find that there is a large increment. And I find the same trend going up to next year. By the time we are getting exports inquiries too. So I'm sure there will be a large growth this year as well as next year.
That's what I wanted to talk about because, as of now, around 20% of your revenue is coming in from exports. Help us understand where the mix, both between revenue coming in from domestic as well as exports businesses is likely to shape up going forward.
See, during this year, somewhere we will stand at 20 to 24%. That is this fiscal year of 23-24. But end of 24 onwards, I am seeing exports going up because exports, there is no growth. This itself, we are able to withstand because of adding new customers to our base. If we had not done that, our exports would not have grown. So, whereas domestic businesses is where I am really seeing a good growth, and it is shown in all verticals of ours.
Historically, markets have not liked companies which are dependent on government. Your largest vertical is railways, which is dependent on government. Now you're sounding confident about your railways vertical, but isn't that a vertical which could be volatile depending on government policy making? Past experiences that when you're over dependent on a government vertical, numbers could be volatile.
As far as we are concerned, though our largest vertical is railway, but today automobile is also equally strong, and we are a widespread company. We do for industrial, we do for everything. So our risk is managed between these verticals.
Who are your nearest competitors? Whom are you competing with when you are bidding for a railway contract or an automotive contract?
See, we are not directly dealing with the government or Indian Railways. Our contracts are with Hitachi. Our contracts are with Siemens. So we are a tier 2 company. So as far as we are concerned, we have orders confirmed for the next 24 months, which they in turn have got from Indian Railways.
Okay. Just to switch gears.
Different sectors, let me also answer one question of yours. In different sectors, we have different competitors. As far as railways is concerned, we are 90% of Indian rail signaling boards are going from us. Onboard equipments, we are trying to get qualified. So I'll see that our company is playing a big role on onboard equipment too.
Okay. Could you walk us through how exactly are your receivables in the private space and in the government space?
See, we don't have any government space at all. We are in the private space. But our type of business normally goes on a 90 days credit, sometimes even 60 days credit. So our receivable days are anything between 60 to 65 days. So this is where we are in. But going forward, as the company grows, we will see this also improving a lot because there are various other financial instruments available with these large players. Hello.
All right, Ramesh, really appreciate your time and thank you so very much for joining us. In moments from now, we'll also be joined by the management of Prestige. But before that, I want to point out the stock of Raymond. Not that I've picked up anything which has come out over the weekend now. Stock's up 80 rupees. A 700 rupee stock has become a 1500 rupee stock. The trigger same time last year was that they would be looking at selling their beauty care business, which is into men's grooming and other pockets of healthcare. But the deal has not gone through after the meltdown in some of the startup valuations. But the stock has done exceedingly well. That's today intraday graph for you. Last 1 year change, please, for Raymond. And you'll see a wonderful spike there. In fact, some of the real estate 70% higher. Hello. That's not the story with any other large real estate company or any other large textile stroke real estate company. So talk about re-rating in stocks. This is one stock which has seen massive amount of re-rating. Mr. Irfan Razak now joins us, Chairman and Managing Director with Prestige. Let's connect with him to talk about how things are shaping up. I'm only getting good news from real estate builders, from Macrotech to DLF to Max Ventures to Prestige. Where is this sudden demand coming from? I mean, all of us thought that Mehngai, high interest rates, affordability, those factors would be at play.
Good morning, Nikunj. Yes, the good news has been happening in the last few years, I think at least 3 years now, post-COVID. And the whole demand is coming in because now the customer has got the confidence that they'll get the delivery, and because RERA is in place, and obviously there's a need to buy a house. So I think the business is happening quite good and pretty robust.
Out in numbers, Mr. Razak, because your FY23 pre-sales, they came in at an uptick of 25%. What's the growth in pre-sales that you're expecting for FY24 now? And you think a number of 15,000, 16,000 odd crore rupees is possible?
Yeah, I think it's not, we have to make it possible. The thing is, we also have certain amount of planning that we do. Like last year when we completed 10,000 FY22, everybody said that nobody else has cleared 10,000. And then at that time only we had given a 30%, 25 to 30% uptake on the previous year's margin. And we managed it. We said we'll do 12,000 and we achieved almost 13,000. That is just a bit short of 13. So I think, and more than that, you see the collections have been good. The collections have also equally sort of kept pace, and the collections have been almost 10,000 this year. And I think going forward for FY24, I can safely say that we are looking at a number jump of at least 20% to 25% again.
Okay. You think the growth in FY24, Mr. Razak, would be largely volume-led, or there is scope of pricing improvement also? For FY23, for instance, the average realization was at about 8,800 per square feet for apartments, villas. Commercial sales, you think, will be at a similar level in FY24?
No, actually, the component of sales in commercial, even in FY23, was very minuscule, just about 800 crores. And we really don't intend selling commercial. We would like to build and rent and maybe at some point monetize that. But in case there's a big opportunity from a large corporate, we can't say no. So that's where it adds up. But talking about pricing, I think the pricing is in the mid-segment. Whichever city you are in, mid-segment for that city, each city has a different mid-segment pricing. And if you are able to manage that, and if I'm able to get those numbers, yes, the premium and the luxury also is giving volumes. Today in Prestige, whichever city you go to, our luxury product is fully sold out. Now we are generating that product in every city, Mumbai, Hyderabad, Bangalore. Again, we are trying hard to see that we get the right product, to see that we don't have a gap in that space. But the volume game definitely comes from the mid-segment, and we will continue to build that mid-segment.
The premium and ultra-luxury segments as well have performed very well. At least, that's all the chatter that we're getting from Mumbai-based realty players. Tell us what's been your observation as well. And you think that's a trend that's likely to pan out for FY24 too?
I believe that the same trend will continue. But having said that, we should be very, very careful on our pricing. I mean, the market is extremely price sensitive. And we definitely have to make sure that we don't get carried away, don't give wrong deals to landowners, or buy land at some very high premium, hoping that we'll set a high premium. We have to be conservative at the time of finalizing any deal, and we have to be conservative when we bring the product into the market. We have to endeavor, even in the luxury section, to try and give the best with the as low a price that is possible, which is obviously it is the land cost and construction cost and other overheads, etc. And we have to watch our costs. If we don't watch our costs, I don't think we'll be able to survive in the market.
Razak, what about the new projects and launches? What's been lined up in the next few months?
There are many projects across the country. We have projects in Bangalore. We've got a lot of projects that hoping that we'll get the approval. Maybe if those approvals that have come, they would have hit the FY23 numbers. We've got two very large developments coming up for this quarter, hopefully, which is the Prestige Lavender Fields in Whitefield. Another is the Prestige Park Grove. Again, a very large development, again in Whitefield. Apart from that, Mumbai will see hopefully another big launch, which is the Prestige Ocean Towers in Marine Lines, and then followed by Prestige Nautilus, but probably not this quarter, but the quarter after that. And Hyderabad will see the largest project that we've done, which is the Prestige City Hyderabad, which will have villas as well as high-rise apartments. We are just waiting for the approvals. The lands are all tied up. And moment those come in, this quarter we'll get revenues from these projects. Apart from Chennai, which is the Prestige Pallava Gardens, and Chennai, of course, the approvals, again, it's all locked in. It's all a matter of how much time it takes to get the approvals.
And what about your plans to look at newer segments, warehousing, micro markets? What's the expectation from this?
Warehousing, we've already done. We have lands which are tied up for warehousing. Warehousing will not give me any top line revenue. It's again a capex driven market. We have done one product in warehousing, and we hope and wish to continue that. It's work in progress. So there is scope in warehousing. We've done this in Bangalore and we'll continue it in Bangalore. Once it succeeds well and we stabilize there, maybe we'll take it across to several other cities which we are present in.
Your debt targets, given that your current net debt stands at about 4,200 crore rupees, with the capex plan in place, what is the outlook on your peak debt equity ratio?
Yeah, see, now this is something that we have to be very aware of. We can't let debt go spiraling high. Again, it will be counterproductive. So while we are doing capex projects, our endeavor will always be to see that whether we can get an equity player along with us. Because it's not only in warehousing or in office, we are also doing several hospitality assets. We are also doing several malls. Two of our malls are trading just now, which is the Prestige Falcon City in South Bangalore. And then the other one is just about to open next month. It is the Prestige Forum Thompson in Kochi. Now, these are products that are almost ready, but there are many more under production. And this definitely will require capital. Of course, our endeavor will be to see that the free cash flows from the DevCo business will go into this. But there will be a certain amount of debt that's required. But our endeavor always will be to see that we put in some 60% equity and bring in 40% debt. That way we balance ourselves and there'll be no stress on the balance sheet or on us.
Broadly, what kind of rental income we should expect in next 3 years from Prestige's balance sheet?
I didn't get that.
The rental income, Mr. Razak.
Rental income, see, we are in FY23. Our target is in 4 to 5 years from today, we should be having at least a target of 3,500, and we will achieve it because there are several products we are doing across the country. We've got Pune, we've got Hyderabad, we've got Bangalore, and now, of course, Mumbai in a large way. All these will be getting ready in the next 4 to 5 years. And with this, we should very, very surely cross 3,500 annually. That is only for office. And plus, we do have a segment of retail, and even that will contribute in a big way.
So when will you be $1 billion company in terms of PAT? That's what everybody wants to know.
We are working towards it. I'll
Your
come
smile
back.
tells me that there is a number you worked already on it. I mean, I'm talking to Irfan Razak, who knows his numbers very well. I don't know whether it is a yes or a no.
No, I don't want to sound too presumptuous at this moment. We are, of course, always ambition is there. We'll come to it. I think you've put a thought in my head now, and I think we'll all be working towards that. I just don't want to throw one number saying yes or no at this juncture, but we'll get there because the whole team is working hard.
This is not an original thought. I'm sure of it. You've thought through it already. You may not want to share with me, but this is not an original thought which I've seeded. That I know.
Okay, thanks.
All right, Mr. Razak. Appreciate your time and so glad you could join us.
Thanks so much. Lovely talking to you.
Let's take a break. $1 billion when? Soon. That's what the management of Prestige has to say. Let's take a break.